Welcome back. This week, we'll be examining the contents of AUC 520 and AUC 315, both of which address analytical procedures to be used in the course and scope of performing an audit. Now, when I think of analytical procedures, I think of spreadsheets. I think of Excel. I think of pivot tables and formulas, things that can be used to examine relevant sources of data. And that's pretty much what analytical procedures are. They're audit procedures that examine the relationships between financial and non-financial data and investigate fluctuations between what is expected and what is observed. These can be as simple as Excel procedures, but they can also be quite complex, using statistical analysis to project results. Common examples of analytical procedures include comparisons, and that is comparisons with prior period results, with expected results, and with industry information. Analytical procedures can also examine what relationships are expected and what relationships are predicted. These include relationships between and among financial statement information and non-financial statement information, as well as the items within a financial report. Analytical procedures are used throughout the audit to provide a deeper understanding of the entity and identify the need for additional risk responses. This would occur during the risk assessment phase of the audit. Analytical procedures can be used during the audit testing phase to evaluate relevant assertions, especially as justified by the assessed risk level and the need for such tests. Finally, analytical procedures are used so that the auditor can conclude on the financial statements and identify areas where they need to supplement their initial procedures with additional evidence. This occurs during the report preparation and during the final phase of audit testing. These last procedures are mandated by the audit standards. The auditing standards specify when and how the auditor is to use analytical procedures. In doing so, the auditor must first select procedures that will help evaluate the relevant assertion given how the auditor assessed risk. And remember, there are 5 relevant assertions: completeness, valuation, existence and occurrence, rights and obligations, and understandability and classification of the final reports. Once the auditor has selected which analytical procedures to use, the auditor must evaluate the reliability of the data that they'll be using to support such testing. Once they've completed that, they'll establish their expectations for the analytical procedures. These expectations can be account balances, ratios, and evaluate these expectations based on the likelihood of material misstatement and the assessed risk level. And we'll talk about the precision that goes into formulating these expectations in a few slides. In the 4th step, the audit team evaluates the differences between what the auditor expected to find and what they did find. And finally, they describe any additional test work that's required based on these identified differences. These final 3 steps must each be documented in the auditor's working papers. In order to perform analytical procedures, the auditor must first gain an appreciation for how reliable the data that they will be analyzing is. This includes an understanding of the origination of the data, which system, which personnel within the company, which accounting module. They'll evaluate whether the data is comparable at a high level to prior years and to related industries. They'll evaluate if the data is relevant to the relevant assertion and the audit tests being performed. And perhaps most importantly, they'll determine whether the data was generated by a system with appropriate controls. The more reliable the system that generated the data, the more trustworthy your analytical procedures will be. Let's practice your comprehension with a CPA exam question. Analytical procedures used in planning and audit should focus on what? And I'll give you a couple seconds to read through your choices and select the one that's correct. The correct answer is D. At the beginning of an audit, when you're planning and assessing risk, you perform analytical procedures to gain a better appreciation of the client's business. You can't use the planning estimates to identify material weaknesses in internal control, so A is out. You haven't collected any evidence yet, so B is out. And you haven't performed any substantive testing, so C is out. Again, the correct answer is D. Analytical procedures are often used during the risk assessment process to gain a better appreciation of the assessed level of risk. This occurs through identifying any significant events that have occurred since the prior year audit, identifying any unusual transactions, events, and amounts, and highlighting areas that are susceptible to material misstatement. As an example, if you were performing the fiscal year 2020 audit and you saw that investments increased significantly when the overall market performance was down, this might identify an area that you'd want to test during your audit testing phase, and an area where material misstatement could have occurred. Once the audit team has assessed risk, they begin establishing what they expect. This is a pivotal phase of substantive analytical procedures, and they must be rendered before opening your Excel spreadsheet. Without a baseline for comparison and a range of acceptable responses, any analytical procedures performed are meaningless. So the auditor must ask, in designing these analytical procedures and establishing their expectations, what level of precision is required. If the analytical procedures are to be the only procedure performed, then your estimation is going to need to be more precise. There's less wiggle room when it's the only test to be performed. Secondly, if the analytical procedures are being performed to support one of the relevant assertions, you're going to have a more narrow estimation of expectations. And finally, if the relationships are unpredictable, you're going to need to render a more precise estimate. For example, research and development expenditures and accruals are both highly subjective and can vacillate wildly from year to year. Income statement items, on the other hand, tend to be pretty predictable. For these low predictability items, you want a more narrow range of precision. For these high predictability items, you can be a little less precise. And speaking of less precise, you can render a less precise or a broader range of acceptable results when substantive audit procedures are performed in conjunction with other tests. That is, they're not designed to stand alone. And also, when the audit procedures are performed using disaggregated data. If you've ever looked at a giant spreadsheet and tried to draw conclusions from it, you understand this challenge. When you're able to look at a more finite population of data, you can improve your accuracy. Now, sometimes I think it helps to look at a CPA exam question to illustrate a concept. So let's do that now. Which of the following statements is correct regarding the predictability of analytical procedures in a financial statement audit? I'll give you a couple of seconds to read through your choices and make your decision. The correct answer is C. Relationships involving income statement accounts tend to be more predictable than relationships involving only balance sheet accounts. Remember, the balance sheet is a snapshot at a given point in time, and that changes by the minute, by the day, by the week. Whereas income statements accounts show the flow over time. Therefore, they're a little bit more stable. Let's look at the other choices and why they are incorrect. Answer D is the exact opposite of the correct answer, answer C. So we know it's wrong. Let's look at B. Relationships involving transactions subject to management discretion tend to be more predictable than automated transactions. We know that's wrong. Accounts where management has final say into the balance can be anything. So thereby, they're less predictable. And let's look at A. Relationships in a dynamic environment tend to be more predictable than relations in a stable environment. And we know that's not true. Predictability and stability almost go hand in hand. A dynamic environment would be the opposite of that. So again, the correct answer is C. Once the audit team has set their expectations for the relevant audit procedure, then they perform the tests and compare the tests to what they expected. The amount of variation that an auditor is willing to accept depends on whether that's a material account, what level of assurance is desired, and the assessed risk. Basically, the more precise your estimation, the less allowable variation. The wider the margin when you're comparing to a precise estimate indicates a higher likelihood of material misstatement. But in areas where you're dealing with less precision, that is a wider range of acceptable results, you can have more allowable variation from reality to expectations. Depending on the nature of the procedure, it may be necessary for the audit team to perform additional tests. If this is true, they would document these additional tests in the working papers, perform these additional tests, and then render a final conclusion about material misstatement. AUC 520 requires that analytical procedures be used when the auditor is forming their overall conclusion on the financial statements. They render this overall conclusion through reading the proposed final financial statements, evaluating their evidence that was collected throughout the audit, and determining whether that evidence is sufficient to support the financial reports, identifying any omissions or any new risk areas that emerged since they performed their initial risk assessment testing, and supplementing with additional testing as needed. This testing can include following up with management to make sure that they've got a clear grasp on the why. Now let's test your understanding of the audit standard and the reading. The purpose of applying analytical procedures in the overall review stage of an audit includes assisting the auditor in all of the following except, I'll give you a sec to think about it. The correct answer is B, enhancing the understanding of the client's business. As you saw in a previous question, that process occurs during the risk assessment phase. Each of the other processes that are described occur in the final review stage of the audit. This is a great example of a CPA exam question because it wraps a lot of concepts into a single question. In asking, which of the following is true about using analytical procedures as a substantive test? So take a couple of seconds to read through your choices and think about your answer. Now, the correct answer is D. Analytical procedures are not required to be used as a substantive test, and they are more likely to be used for accounts that are predictable. What in the world does that mean? What is a substantive test? Well, it's a test that supports a relevant assertion. It's a test that can be used to identify material misstatements. Do you have to use analytical procedures? No. They're a great tool. And when account balances are predictable or relationships are predictable, they can save you, the auditor, a great deal of time. But you don't have to use them. In fact, there may be occasions where you shouldn't use them because they don't add to the overall experience. So let's look at the other answers choices and decipher why they're not correct. Item A, analytical procedures are only required to be used. That's a giveaway there. They're not required to be used as a substantive test. They're required to be used when you're concluding on the overall presentation of the financial statements. Let's look at B. They're not required to be used as a substantive test. Okay, that's correct. And are more likely to be used when transactions affecting the account are subject to management discretion. Well, we just learned that accounts that are subject to management discretion are less predictable. And we know that analytical procedures work best when the relationship with the account balance is predictable. So that's incorrect. Item C, analytical procedures are required to be used to some extent as a substantive test. And again, they're not required to be used as substantive tests. They can be if it's more efficient, but they're not required to be used. So this lecture gives you a good idea of the substantive tests. You'll do an exercise this week that addresses analytical procedures as you continue your thought process with Tesla. Happy analyzing!